Shares and taxes. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I thought we'd have a look at this article from Yahoo discussing shares and taxes, what you need to know, written by Mark Chapman. Because, well, I know a lot of us who are watching the channel are also investing, and some of you are getting those nice tendies and profits, and of course the government will need to take their slice of your rewards, your gains. Isn't it awesome paying taxes when, particularly for the crypto people, you invest in cryptocurrencies overseas, nothing to do with Australia, probably exchange it on foreign exchanges, and then they want a slice of it because somehow, I guess the private companies that provide you with internet, yeah, anyway. So, if you dabble regularly in buying and selling shares, are you a share investor or a share trader? The answer to that question will determine how you're taxed on any profits or losses you make on your share portfolio. A share investor is someone who buys shares to hold them long term, benefiting from the growth in value of the share and any income earned through dividends. So that's what I would consider myself. I'm a share investor. I've been doing my pocket money investing slowly, just building dividend income in shares for the last year now. And, it's US shares are doing much better than the Australian shares. But, I didn't have much luck. I picked AGL. I put some money in AGL, guys, and it makes my Aussie portfolio look good. But I've had a few wins. So, yeah, I'm definitely an investor. I'm not a trader. I tried the whole trading thing. I don't know about you, with this cash for difference, and I don't think I have the mentality for it, or I haven't trained myself yet for it. That's probably what I need. Anyway, any profits or losses you make from selling your shares will be subject to capital gains tax, meaning profits and losses will only arise when shares are disposed of. See, we still don't have taxes for unrealized gains. Oh boy, unrealized profits. That's what they're proposing in the US. So if at the end of every year, my AussieBroadband shares, what were they up? 400%. So I'd have to pay tax on that, even though I haven't sold them. I don't want to sell them. I'm just going to sit on them for a while. That's what they're proposing in America. So it's going to force people to sell. It's a complete nightmare. It's a complete utter nightmare. Most people who buy and sell shares are regarded as investors by the ATO, irrespective of how the investors see themselves. A share trader is someone who buys and sells shares purely for short-term profit. Signs that you're a trader include lots of transactions, a clear profit-making intent. You run your activities in a business-like manner, e.g. a large investment of capital, a well-developed business plan, extensive research, and properly maintained books and records. Someone who buys and sells shares as part of a business will treat those shares as trading stock, and gains or losses on them will be treated as ordinary income rather than capital gains. The key to a tax advantage for a trader is that losses can potentially be offset against other income, subject to certain anti-avoidance provisions. Now, here's all the people are talking about. We've got one commenter in the, one viewer who's talking about how people are avoiding tax and all this stuff and having these schemes. I mean, the best and Australian-made way is negative gearing. It's what everyone does. But, they want to catch you whatever way they can. Anyway, when capital gains tax applies and how it's calculated. Okay, when you dispose of shares, assuming you're an investor, not a trader, you will normally have to pay capital gains tax on any profits. Typically, capital gains tax arises when you sell shares, but can also happen if you give them away or you stop being an Australian resident. Capital gains taxes any increase in value from the time the shares were acquired. Your capital gains is worked out like this. Deduct the cost base from the sale proceeds. The cost base is the price you paid for the shares plus incidental costs. Next, take away any capital loss. Then discount the gain. Individuals are entitled to a 50% discount. The asset must have been held for 12 months or more for the discount to be available. The resulting figure is your net capital gain. This is subject to tax at your marginal tax rate. So that's one incentive to hold on to your shares for 12 months. I mean, maybe all of these American taxes they're bringing in might encourage more Yanks to come over to Australia, guys. And what do you invest in Australia? Not shares. Come on, who are we kidding? Aussie property. Sydney Gold. Any shares acquired before the 20th of September 1985 are not subject to capital gains tax. Oh, see, there you go. Boomer privilege. That'd even be before the boomers, wouldn't it? Sometimes the proceeds and costs of the share are not what was actually paid and or received, but rather the market value of the asset. This is typically to prevent people from minimizing their tax by, say, selling the shares to a relative for a low price. So example 1. Kerry sells some shares on the open market in March 2020 for $10,000. She acquired the shares in December 2010 for $5,000. She has brought forward capital losses of $2,000. So she made $10,000 in the sale, cost $5,000, capital gains was $5,000. She lost $2,000, and then the discount of $1,500, and then the net capital gain is $1,500. Okay, good on you, Kerry. So rather than selling the shares, Kerry gifts the shares to her grandchild, Ben, who of course pays nothing on them because the shares were gifted. They will be treated as being disposed of at the market value, and Kerry's capital gains tax calculations will look exactly the same as in example 1, despite paying nothing for them. The cost base of these shares to Ben will be $10,000, their market value. Okay. So what happens if you make a loss? There you go. I mean, it's not all good times, everyone. Remember, the market crashed last year, so there would definitely have been some people who FOMO'd out of it. This is the thing. If you're like a day trader, you've got to spend a lot of time on it. It's a full-time job. I don't think you can do it on the weekend. The only way you can make money on like the weekend or after hours with day trading is probably selling courses on how to do it. I know one guy I was watching, he trades the news, so the morning news he trades and does very, very high leveraged amounts to try and make money. But it comes with your risk profile, guys. Anyway, if your sales proceeds are less than your cost base, you'll make a capital loss. These losses can be offset against capital gains arising in the same year, and to the extent they are not used up, they can be carried forward indefinitely until capital gains arise to absorb them. Okay, and this is why Trump, he didn't pay any income tax for so long. Or no, that was it. Yeah, maybe. I have to look into it. I know he made losses and carried them forward. It wouldn't be this. Capital losses can only be offset against capital gains. That's the thing. So you can't offset it against your income, which kind of sucks. Oh, well. If you dispose of an asset during the year and crystallize a capital gain, you may want to consider disposing of any other assets you own that are sitting at a loss. That way, the capital loss can be offset against the capital gain. This is a popular year-end strategy with share investors. Be careful, though, if you sell loss-making shares to crystallize a capital loss just before the end of the tax year and then buy the shares back again at the start of the new tax year. The ATO regards this as an artificial contrivance to generate capital losses. What? Oh, come on. Of course it is. That's what the point of doing it. There you go. Oh, well. See, guys, they'll catch you everywhere. They'll catch you. Tax on dividends. The most common way for companies to pay returns to shareholders is by way of a cash dividend. Dividends are paid out of profits, or in America, they borrow money to pay you dividends on some companies, so you got to watch it. Watch yield chasing, guys. Anyway, dividends are paid out of profits that have already been subject to Australian company tax, which is currently 30% or 25% for most small companies. Recognizing it would be unfair for shareholders to be taxed again. Yeah, see, this is why we've got franking credits, guys. This is why, because you don't want to tax people twice. I don't know why people don't get this. I guess it must be the people who want to get rid of franking credits. They're the ones that probably don't pay any tax. Anyway, on the same profits, shareholders receive a rebate for the tax paid by the company on profits distributed as dividends. These dividends are described as being franked and have a franking credit, also known as an imputation credit, attached to them, representing the tax the company has already paid. The shareholder who receives a dividend is entitled to a credit for tax the company has paid. If the shareholder's top tax rate is less than 30% or 25%, when the paying company is a small company, the ATO will, under current rules, refund the difference. There you go. You get extra money. This is why the pensioners are getting living off their franking credits. They're getting those refunds because they're entitled to it. It's fair. It's reasonable. So if any stupid lefty complains and bitches and moans about franking credits, they're jealous. That's all it is. They're jealous. They don't get it. They don't get it. So, how taxes on dividends work. Let's say you hold 100 shares of ABC Limited. Who'd want to buy the Australian Broadcasting Corporation anyway? They make $5 of profit per share. It pays 30% tax on that profit, which is $1.50 per share, leaving $3.50 per share to be either retained by the business or paid out as dividends to shareholders. ABC Limited decides to retain 50% of the profits within the business and to pay shareholders the remaining $1.75 as a fully franked dividend. Shareholders receive this with a 30-cent imputation credit, which isn't physically received, which must be declared in the shareholder's tax return as income. This can then potentially be claimed back as a tax refund. The taxpayer therefore receives $2,500 taxable income from ABC Proprietary Limited, being the $1,750 dividend income and the $750 franking credit as follows. Okay, there's the dividend, there's the franking credit, and there's the taxable income. Okay, applying that to different scenarios with different tax rates. Okay, so if you've got 0% tax rate, after-tax income is $2,500. Okay, the dividend, imputation credit, taxable income, gross tax payable 0, franking credit rebate $750, tax payable refund. There you go. So you're going to get it all back. Investor 2, they're only going to get $375 and then 0, and then they have to pay $375 if you're at the 45% tax rate. This is why when taxes go down, all the people earning more money get more back. And every bloody article I read, journalists, I don't think they get it. I really don't think they get it. They're all bitching and moaning about the rich getting more tax back because they pay more. Anyway, so investors 1 and 2 both receive refunds. Investor 1 might be a super fund in a pension phase which doesn't have to pay tax at all and which uses the franking credit refund to fund pension payments. Alternatively, it could be an individual who has no other income other than the dividends of these shares. Investor 2 may be a self-managed super fund in accumulation phase which uses the excess franking credits rebates to offset the 15% contributions tax. Investor 3 would typically be a middle-income individual who does not have to pay any extra tax despite receiving $1,750 in income. Investor 4 would be a higher income earner who has to pay some tax on the $1,750 dividend but has reduced his tax rate on this income considerably due to the franking credits. So dividend reinvestment plans. Now I know there's some people who really love these. I know AGL, what was it? Because I'm not doing any dividend reinvestment plans. I want the cash so I can distribute it how I want. But I can see the advantage of it. But with AGL, they were reinvesting the dividends at a higher rate than the actual market price of the shares. So I'm sure a lot of people were pretty frustrated with that. In some cases, shareholders are given the opportunity to reinvest their dividends in additional shares in the paying company. If this happens, the cost base of the new shares for capital gains tax purposes is the amount of the dividend less the franking credit. Crucially, if you reinvest the dividend in this way, your income tax liability on the dividend is calculated in exactly the same way as if you'd received a cash dividend. That means you may have an income tax liability and no cash to settle it because the cash was all reinvested. This needs to be kept in mind when you consider whether a dividend reinvestment plan is right for you. Are international shares treated differently? In essence, the rules for international shares are the same as for Australian ones. You'll be liable to capital gains tax on any shares you dispose of, and you'll be liable to income tax on any dividends you receive. The exception to this is that international shares won't have franking credits attached to them. So there we go, everyone. Some useful information here. Let's have a bit of a talk. So what do you think, guys? I mean, are you investing in the stock market? I think there's a multitude of opportunities to invest in to position your money. I like REITs. I particularly like American REITs, real estate investment trusts, that pay a monthly dividend just to get a stream of money in there. there's also a lot of opportunities around, but the market is very hot at the moment. And, well, here's the thing. When people say, don't invest more than you can afford to lose, that's not with the expectation that your money will disappear. That, I would say, is with the expectation that if the market has a panic-induced crash and you won't be influenced to jump off with the idiots. You will ride it out. So you'll ride it out because it'll come back up again. What do you think? Anyway, guys, let me know your thoughts and opinions on this. I'm quite interested in building up dividend income as an additional passive income. Right now with pocket money I've been collecting together. Every few dollars you get, guys, that's money you haven't had to work for. I wish I had started it when I was 20 and just slowly built up a stack. But, better later than never. And at the very least, it's what I want to encourage the children to do. We'll see how it goes. Anyway, guys, check out this last video I did about, what are we going to look at here? I don't know. I've got to think of something. Buying silver. That's it. We'll check out this video about buying silver. Take care, guys, and I'll see you next time.